Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Darius Foroux, the author of the upcoming book, The Stoic Path to Wealth, which by itself sounds pretty contrarian. Who would think of generating wealth, acquiring wealth as something that a Stoic could accomplish? But we're actually going to talk about that. And actually, why don't we start with that? Why don't we start with tell me about this book and what the general idea is, and then we'll use that as a way to talk about your views on markets. You have a strategy for investing in public equities as well that we'll get into. But yeah, first up, the book, The Stoic Path to Wealth. Tell me about it.
Yeah, so I've been a long-term investor in the stock market. I started in 2007, right before the financial crisis, and I bought my first financial stocks at the time, thinking that because I worked at a bank at the time at ING, and I thought everything is looking great from the outside. Of course, I had no clue what was going on the inside. And then a year later, I was down 60% in my portfolio. So that experience put me off from investing for many years because I just couldn't handle the gut punch. And I actually held on to my stocks until like 2009 or 10, right before everything really bottomed. And then textbook first time investor story. You buy at the top and you sell at the bottom. So I was always looking for a way to get back into the markets, and that's when I found stoicism. So fast forward to 2015, and I realized, like all of these years that I spent studying investors and investing and getting degrees, etc., didn't help me to get back into stocks. But it was, philosophy of all places that helped me to finally get the confidence to trade stocks again or invest in stocks as well. So that's when I put those two things together, because stoicism is really a framework for managing your emotions. And I love the title of your podcast, the Contrarian Investor Podcast, because I think that every successful long-term investor is a contrarian. Warren Buffett, to me, is a contrarian. Any person who just does the opposite of what the herd does, which is often to go with the flow and with the trends, and has the emotional fortitude to maintain or stick to their strategy, to me is a true contrarian. So that's how I view myself as well, and also the Stoic Path to Wealth that I call it, I feel is also a contrarian path in today's world.
Absolutely. Yeah. So let's talk about this idea of stoicism to those who maybe don't remember their intro to philosophy classes or maybe didn't take them. For me, I just think of that guy living in his in that tube or in the what was it, the barrel. Was it Diogenes? Yeah. Is he a Stoic? Was he a Stoic? Talk us through this. Who are the early Stoics?
Diogenes, I believe he was a cynic, I believe,
okay.
if I'm not mistaken.
Okay.
Yeah, but Stoicism actually is influenced by cynicism, because at the time when Stoicism started, so let's say like 2,300 years ago in ancient Greece, the two main philosophies of the time were cynicism and Epicureanism.
Okay.
And Epicureanism is, of course, the philosophy of chasing pleasure. And cynicism is basically renouncing all pleasure and accepting that life is really hard, whilst the Epicureans would say, yeah, life is hard, but let's numb the pain by chasing pleasure. And then the Stoics came up and said, look, life is about balance. We need to endure the hardships, but also make sure that we enjoy our life as well, because life is short. So that's what I love about the philosophy. It really takes a balanced approach. But the funny thing is that balance always sounds fun and great and makes sense, but it's really hard to accomplish. And I feel like this is why so many people struggle with that. So Stoicism is really not about the word, like the word stoic, or like person who doesn't have emotions, etc. I feel it's more like being in tune with your emotions and understanding them, and making sure that you don't become uh, victim of your own emotions. I feel like that's the core of the philosophy, to focus on what you control and ignore all the noise.
And that how that would translate into investing is obvious, ignoring noise. But practically, how does one do that? I mean, every single person on Instagram and Twitter is talking about successful trading and how mastering your emotions. Easier said than done, right?
Yeah, 100%. But especially if you are active online, like almost everyone in today's world. Um, One of the first things that I focused on when I discovered Stoicism was that I needed to eliminate 99.9% of all of the investing strategies that exist in the world,
Mm.
because the Stoics really remind you to focus on what matters and to start by the things that you control. And ultimately, that's basically our decisions and our judgments, right? Other than that, we don't control the economy, the markets, we don't control what other investors do. So I always try to translate everything that I read from Stoic philosophers like Marcus Aurelius, Epictetus, Seneca, Musonius Rufus. These are great thinkers. I always try to translate what they said to the markets. And to answer your question, like how does one do that? I think when you start by elimination, I feel you start to get more clarity. And when you have clarity, you can develop more self-confidence. So the way that I did that was I sat down and I said to myself, okay, there are all these types of ways that you can generate wealth, because ultimately that's the goal. We want to build wealth. Um, and I said to myself, I can become a value investor, I can become a momentum trader, I can try to become a day trader, while everyone says, of course, doesn't work. But I always think if it really didn't work, there would be no day traders or short-term traders at all. So I do think it works, just the odds are against you. So it's not a thing or an activity that's worth my time when I was looking at it, because I feel like the odds are so against me. Why would I pursue that? Why would I invest my time in that? So I start to eliminate all of these options: futures, options trading, gold, real estate. And I boil it down and I'm like, okay, what's the simplest investing strategy to start with? Just invest in the S&P 500 index. So that's how I started. And I got back into the market and I started to feel that confidence again. And I kept doing that for a few years until I came back to my original desire, which was to also pick stocks.
Mm.
And the way that I did that was by building that confidence and staying focused on the habit of investing, and trying to create some distance between myself emotionally and my portfolio.
Mm.
Because that was the thing that got me in the beginning. I invested all of my savings at the time, and of course, it wasn't that much, but still, I was just too involved. And realized that's really the wrong way to start to invest, just period. Because when you feel like the stakes are so high, you feel like you need to do something. And yeah, investing, as we all know, it's about the opposite, right? It's not like not doing something when when markets do what they do. So that's how I really applied this philosophy to get started with investing and apply Stoic philosophy to my investing strategy.
You mentioned confidence, but can that also be one of the emotions that you want to stay away from, especially overconfidence?
Yeah, 100%. Yeah, overconfidence, especially remember like in 2020 when all these young investors and 21 came to the market and everything was going up and you just couldn't lose money. I feel like when you start investing out that way, it's very easy to feel overconfident and think that you're a genius. But at the same time, we also need to have confidence in our ability to stick to our strategy, I feel. Because if you don't have confidence in the strategy that you've picked, you'll probably abandon it. Soon as something goes against you, you feel like, oh, okay, no, this is not it. I need to find something else. Maybe this guy has the answers, or maybe I should read this book, or maybe I should do so and so and find another strategy that works. Well, your strategy probably was okay, was maybe, unless you figured out something on your own, but as long as you're sticking to the basics of investing, um, it there's nothing wrong with the strategy itself. It's like
Right.
likely you.
Yes. Yes. So, what are some? Well, you mentioned the emotional elements as one common mistake that people make, and it sounds like deviating from a strategy is a bad one as well.
Yeah.
Is that a fair statement, you think?
Yeah, I feel so. I feel that's really the case. As long as you pick a proven strategy and you execute it the way you should, um, I think that's fair to say. To deviate from that means that you are taking away, that you are destroying your own odds of becoming successful with that.
Right. All things being equal, isn't all this isn't just beta being a beta cowboy, like riding the indexes, just the best way to go?
Yeah.
Because if everything's going to go up over time anyway, and if I'm just sticking to a strategy and the strategy is going to track the index, shouldn't I just put my money in an index?
Yeah, I feel for most cases, for most people, I feel like that's probably the best way to go. And I always say, to people who want to pick stocks, it's like, are you obsessed with the market? And if the answer is no, I would say, just stay away from trying to picking stocks because then you end up being sour or saying, yeah, Wall Street is for three-piece suits or whatever,
Mm.
And like I'm bad with money, I'm bad with investing. Yeah, it's for rich people or whatever. And I feel like for those folks who are just obsessed with the investing, obsessed with markets, it is the only point to beat the market. For me, it's not really, right? For me, it's like because it's like a way of life almost. I've been addicted to the stock market since like I watched Wall Street when I was in my teens.
Hmm.
Like so many other people,
Yeah.
right? And I loved it ever since because the stock market to me is where psychology, history, um, competition, politics, and everything meets in one place. So I'm really fascinated by the mechanism and by the movements of the market. But I feel like, you know, I don't know if you can relate to this, but like you have a podcast on investing and people who are listening to this also have a an interest in investing that the average person doesn't have. I assume, right? I don't, is that fair to say? Yeah.
Probably, yeah.
Yeah. So, yeah, we take it a little bit differently. So I feel like when you put too much pressure on yourself, like, yeah, I need to perform, like I need to beat the market. I need to do this. I need to do that. And it's like, why? Like, okay, you don't want to lose money. That's something universal, but also just enjoy the ride. Like investing is fun. It's interesting. It's an intellectual pursuit, and even if you don't beat the market or you at least do well according to your standards, and you grow your portfolio. Who cares if you don't beat the market? That's how I feel about it, and I like it's more of a mindset. And of course, I don't want to lose money, and I do everything within my portfolio the way that I construct it, which is very simple. Like I'm not an investing genius, like I was saying before we started recording. Like I put 90% of my portfolio on the S&P 500, and then I take 10% to pick a handful of stocks, mostly like two or three.
Okay.
And that's how I feel like I can gain a little bit of an edge, because I only started doing that when my portfolio was a bit more substantial, because I feel like if you have a few $100, and even if you have 100% return, like congrats, right? Like
You still have a few $100.
yeah, but the alternative is you could spend that time to get that few $100 in the market to invest in your skills and your career, and maybe get a raise and get that few $100 every month, and then take that money and then invest in the market. And then if you have more capital, then you can invest more, or you can miss more money, or I should say you won't miss the money that you invest. You can make thousands potentially. And I feel like that's a better promise to yourself, and makes it more worth it. So that's how I approached everything very slowly. Yeah.
Sick of me yet? Become a premium subscriber and avoid all ads or interruptions. Other benefits as well. Visit contrarian.supercast.tech for more information.
So 90-10, so 90% in the S&P, 10%. You say you only pick 2 to 3 stocks. How do you go about picking those?
Yeah, mostly I try to stick to 2 to 3 stocks. Yeah, that 10% is my strategy is really influenced by traders like Jesse Livermore and Nicholas Darvas, and reading all of those books, and William O'Neill. But at the same time, also having a little bit of a long-term approach of value investing, not technically, but just more of the philosophy. I can give an example. So last year, I started a position in Adyen. It's the Dutch version of Stripe. It's a Dutch company. They're a payment processor for large corporations like Uber, McDonald's. They are the biggest processor for all of these S&P 500 companies, right?
Is there an ADR, or is it just trades in Holland?
Yeah.
Okay.
Trades on the AEX exchange in Holland. And but for example, like I think Kathy Wood owns it, and a lot of folks in the US also own it.
Okay.
But it's been around since like 2003 or whatever. They have a relatively small team compared to Stripe. They have great margins. Last year, the stock was trading at like 80, 90 PE, and I was tracking it for a very long time because I love the company, I love the model, and I really, it's a business model that I understand, just taking a cut of a payment. And as long as these major corporations keep growing, even if you don't acquire new customers, I would assume the company will keep growing as well. And there's a major hurdle for these large corporations to switch payment processor. So it's a well-run company. They've been around for a long time. They manage their costs, etc. They have good margins. So I look at the fundamentals, but I was tracking it for 2 years, and I was like, yeah, I'm not okay. I don't feel comfortable with this valuation. And then last summer, they came out with like negative guidance. They were like, yeah, we don't know what will happen to our margins. We might add more people. And investors just slammed them. The stock price was cut in half within a few weeks. And then I was like, I like this. So I started a position in that company knowing that from a fundamental perspective, it makes a lot of sense. And technical perspective, I started seeing a invest or forming a base around like at the time from what I recall, like 700 euros. So I started buying, and I felt really comfortable buying as it went down because I do know as a trader it's not smart to average down, but as a long-term investor, it does make sense. So that's how I combined all of these philosophies. Well, and one of the things that for me as an investor, I always love to look at is institutional ownership because I prefer to stay away from stocks that are heavily owned by the public, by individual investors. So I feel like those are just way more volatile, and institutional ownership to me kind of signals that, you know, this is a solid company. It's been around for a long time. It's proven. Um, and I think Adyen, or Adyen, how you spell it, has like 80% institutional ownership, something like that. Like really, really high.
Interesting.
Yeah, combining all of those things. That's how I started position. And I actually still own it. While at the time I felt like, okay, I want to pursue this as a short-term play. If it gets back up to its previous base, I might sell, but I still felt good. I took some profits and I just let the rest of it ride. It's kind of stalled out over the last couple months. It's not looking really great technically, but for me, because I bought last year, I feel still comfortable in this stock. While I did take some profits as well, so that's how I use my 10%.
Interesting. Yeah. There is actually it does trade on the pink sheets in the US, stock ticker ADYEY, and it's pretty liquid. I mean, they say a $38 billion market cap. I don't know if that's, but it seems to be pretty liquid, and currently trading at $12.13 a share as we record this. All-time high was 1869. So well below that, but also off of the lows, like around the fourth quarter of last year, it was trading in the sixes and sevens. So yeah, it did. But would you add? Would you add here at this level or not?
Yeah, I would add here exactly where it is now today. I've been tracking like it bounced a little bit off this level and then started go back to it. I feel like it's kind of testing it right now. So at this level, I do feel comfortable because it also from a valuation perspective, I feel like it makes sense because they're still growing at like 25% a year. So,
and I'm assuming it's not just in the Netherlands that they have business, but all throughout.
No, it's global. Like, yeah, it's global. They have some of the biggest corporations, like McDonald's and Uber and Nike, I think.
Very interesting. And yet, so it competes with Stripe in the US, but we only hear about Stripe, which is still private. Yeah.
Exactly. Yeah. And the thing with Stripe is that they started out focusing on these small businesses. And Adyen started focusing on major accounts or, corporations. So I think that really played into their favor because I also hear the argument that, payment processing is a commodity. I feel like those people never worked in like major accounts or corporate sales because any commodity where like in B2B and like where there's corporate sales involved, like people are locked in and it's more politics and you know, doing favors and discounts and whatever to keep those big clients. You have to have a really, really strong offer, and really you have to undercut the major players by a lot, I think, to steal their business. So from what I see, they're really good at retention as well.
Mm-hmm.
So yeah, all of that combined, I feel like is a stock where I'm comfortable, you know, and that's ultimately I think the most important thing, whether you're comfortable holding a stock, because I am 100% comfortable owning the S&P. That it's like I never think, oh, okay, you know,
Mm.
should I sell? But with individual stocks, that's a thing that you should actually think about a lot.
Mm.
Um, but at the same time, if you feel comfortable with that stock and everything makes sense, the story makes sense to you, then I think it's much easier for yourself to to maintain the strategy.
Right. Okay, Darius Foroux, I want to come back and ask you some more questions about yourself, about your portfolio, about how you got into, well, you talked about how you got into investing, but how you came to write this book, and some more things. But let's first take a quick break. If you are a premium subscriber, you will not get the break. Do not touch the dial. We'll be right back. In fact, we already are. Everybody else, to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack that where you can sign up for the same prices, same benefits, same details. contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show.
Welcome back, everybody. Here with Darius Foroux. Where are you located, Darius?
In the Netherlands, an hour outside of Amsterdam, yeah.
But this is a segment of the show where we talk about, where our investor tells us a little bit more about him or herself and how they got into investing. You touched on that already. But in your, maybe you'll tell us a bit about how you, got into investing and how you came to write this book.
Yeah, so in 2010, I was in grad school, and I was studying business administration, and still the aftermath of the financial crisis. And I was starting. I wanted to get into finance, and I was looking at traineeships, etc. Everything dried up, and my dad had worked at a laundry or an industrial laundry business for like 20 years. The technical management, etc. Like these laundries that do they wash for hotels and hospitals. And he was like, yeah, I want to start a business for myself. I want to sell these machines. Do you want to help? I was like, yeah, great opportunity, because that way I can learn entrepreneurship and learn how to run a business, um, because I knew that would help me as well as an investor. So, and kind of made sense for me. So I went all in on that. So started a business, and I ran it, helped to run it until 2014, when I felt like, yeah, I don't love this industry. I want to get back into something that is a little bit more related to investing, or at least work for a corporation. So I moved to London, and I worked for Gartner, the IT research firm. And I did that for a year, and I was like, yeah, I love this. I learned everything about corporate sales and running a huge organization with thousands of people, and how forecasting works, and et cetera. Um, so, but I don't love climbing the corporate ladder.
Mm.
So I quit the job, and I moved back to the Netherlands, and I am thinking about starting another business at the time for myself. And this is in 2015. So this is when I discovered Stoicism, et cetera. And I start writing, and I think to myself, yeah, this is a great opportunity for me before I move on to my next venture. I'll write a book. So I write a book called Win Your Inner Battles, about how I conquer fear, et cetera, kind of in my career until that point. And put it out there, start a blog, and all of a sudden I see it's getting traction. I had a few articles that went viral, and I started getting emails from readers, et cetera. And I think to myself, okay, this is great, because it's aligned with what I love, and I'm seeing some results. So I need to keep doing this. So that's how I actually started my writing career. And within like 2 years, I could do it full time. While at the same time, I went back to the family business to, to pay the bills, etc., until I could finally do this full time. And I've been writing ever since. So I've kind of published almost a book a year since
Wow.
2015. Yeah.
Wow. Oh, I didn't realize you had published that many books. I'm assuming you write in Dutch, or do you write in English?
No, English. I
Really?
started English from the beginning. I studied business in English. I lived in London. I started thinking English.
Uh-huh.
And I was like, yeah, I need to reach the most amount of people from the start. And from the beginning, like 80% of my readers were from the US.
Sure.
So yeah, I never stopped. So this is my 8th book right now. Yeah.
Very cool. Wow. All right. So you touched on the one holding that you have other than the S&P. And so are there any others? You said that you had 2 or 3 individual stocks sometimes.
Yeah. Well, at the moment I have 2. So the other one is Tesla, actually.
Ah,
Yeah.
that's not very country.
Yeah, yeah, and it's part of the S&P, and the other strategy that I have is, sometimes there are companies in the S&P 500 index that have underperformed it for a while, where I feel like it's already part of it. They're proven. I love the company. I love the perspective. I know it's not going to zero. I just want to have a little bit more exposure to it. Now, okay, I could buy more S&P, or I could buy the NASDAQ, have a little bit more tech exposure. I feel like, okay, why not just concentrate more? And if I look at the whole index, I feel like Tesla is the only one that really sticks out to me in terms of underperformance over the past. Actually, I was looking at it this week, past 4 years almost. It's like at least last 3 years, since 21, it hasn't done almost anything.
Mm.
And that's not a sole reason to say, oh, okay, like in general, it's more of a recipe for disaster.
Mm.
If a stock hasn't performed well over the past 2 to 3 years, I would generally stay away from that. But I love the story, I love the story of like, oh yeah, we're heading into a recession. No one's going to buy cars. They've sold so many cars. Um, they have so much stuff against them. No one wants to own EVs. Like, as a contrarian, I love that. I love that story. I feel like, just bring it on.
Really?
So it's
No.
more of a bet that Musk and Tesla will prove people wrong. And there's more of a story that I invest in. And what I love about 90-10 is that it gives me some space and confidence to invest in stories or invest in these types of situations, because if I would never do that, if I would have to go 100% picking stocks, I would be way more calculated, way more rational. While I feel like, okay, as a Stoic, I create some distance between me and my money. So I'll say, okay, this 10%, I can say goodbye to it for a long time, and it's money that I won't miss.
Mm.
So I feel comfortable with investing, or actually trading, I should say, trading these types of stocks as well.
How long do you stay in one of these positions for?
Yeah, so I love to take profit when I see it's kind of stalling out. Sometimes that's at 20%, sometimes it's at 50%. With Adyen, I took profit at like 80 something percent because it had a great upward move. And when I start, I don't try to think of how long I'm going to stay in the stock. I feel like I need to maintain my muscle of analyzing the market, see where it's going, and thinking to myself, when is the time to either close the position or take some profit, and potentially add. So another example of last year. So I felt like these payment processing companies were really undervalued last year, like PayPal,
Mm.
uh, Square or Block. So I'll actually also started a position in PayPal last year.
Mm.
And I was up like 15, 20%. And I started seeing it real stall out. And the new CEO at the time came up with some weird claims and all of that stuff. And I wasn't really comfortable with it anymore.
Mm.
So for me, I feel like it's very difficult because if you read all of the stock trading books,
Mm.
almost no one, in my opinion, has a clear-cut system for selling or taking profits. I feel like that's the hardest thing
Hmm.
about trading and investing. So this is why it's so easy to be a passive investor, because you don't have to think about it.
Yep.
But when it came to PayPal, I started a position, I think, at the PE of like 15 or something or whatever, so some really low. Also, again, underperformed S&P. I felt like, okay, I want to have a little bit of more exposure to this. It did good for a while, but then it started to stall, and I started getting a little bit nervous. I was like,
Mm.
okay, do I feel confident enough to average down on this stock? And I
Mm.
told myself, no, I'm not. I'm not.
Right.
I'm not. I don't. If this thing doesn't move upwards now, I'm out. I don't care. And it didn't at that time. So I sold, and I was like, yeah, took
Yeah.
it off my watch list, and I was like, yeah,
That's
you figure
interesting.
it out on your
Yeah.
own. Yeah.
That's an important point because a lot of people, myself included, kind of get married to their ideas.
Mm.
And when it drops, I mean, Warren Buffett does say when the stock drops, you should buy more. But that assumes that you've done all your research
Yeah,
and
exactly.
are
Yeah.
so convinced that it's a profitable business that you can
Yeah.
stomach it. But as you know, if you've fallen into these value traps, once things start going down, they sometimes continue,
Yeah.
sometimes indefinitely.
That's the thing that we were talking about with Tesla. It's like, in general, I feel like if a stock hasn't been doing well for the past 2 years, for a longer time, you can assume that it won't do well for the next year or so. I feel like, I don't know, that's what generally has happened, unless you're a Netflix.
Right.
In my expectation, a Tesla, like a Netflix or a Meta, right?
Yeah, that's a great example. Yeah.
We're going to cut this whole metaverse thing. We're going to cut the staff we're going to focus on AI and have this amazing turnaround story. And it's like such an important company. Okay, great. Then, let's go.
Yeah.
But all of these more value companies, companies that are not really in the mind of the consumer, or not, on Market Watch and Wall Street Journal and Seeking Alpha every day. Those stocks, there has to be something, like, has to be a real catalyst, I feel like, for a big move. And yeah, like we all know, like the investment community is so fickle, it's like, if there's no movement, or if there's no story, we'll
Yeah.
go to the next stock that has a great story,
Yeah.
and we'll drop the other ones,
Yeah.
So like
Yeah.
that's something that I'm always very cautious of. And I can say that is definitely something that like influenced by Stoicism, where, like you were saying, not being married to your ideas and being very indifferent to your own ideas, and like being able to play devil's advocate when it comes to yourself. I feel like is something that Stoicism really talks about. Not directly, of course, with business or investing, etc., but just with your personal challenges and ideas. Yeah.
Yeah. What does a Stoic do to combat FOMO, or how does one deal with FOMO? The fear of missing out, right? Because this NVIDIA is a perfect example. Here's a company that's run up and up and up at a 10-for-1 split. I mean, the last week or so hasn't been great at all, but
Yeah.
up until then, it was up 150, 40%, whatever in a year. And you want to get on board, but, you're missing out on the party if you aren't invested. And what do you do as a Stoic? Sit it out?
Yeah, that's actually something that I have really thought about. I haven't written about it in the book. It is something that I include in my personal strategy, and I feel like the answer is the first thing is never try to find the next NVIDIA.
Okay.
Because I don't know, it just doesn't work in investing. It's like the second like the second option is never
interesting,
right? Like everyone's now, I think, looking at ARM, right? ARM, or
yeah, well, that's just one of them. Super microcomputers, SMCIs, another one. Yeah, I mean, it's funny. I put together a list of what I called undiscovered AI stocks.
Yeah, I feel like if you try to find the next similar play, you risk falling in certain thinking errors, thinking, oh, okay, might have the same. Of course, it could be something related or in the same industry or same kind of same story that we're still in, and with terms of AI. But I feel like if you start out with the idea that you're going to find the next NVIDIA, or we always have these stories, right? In yeah, 2020 was like, where's the next Tesla? Then
Right.
where's the next Meta or whatever? And I feel like that's the thing that you can just use for your mindset, to keep your eyes open everywhere, not just to prove to yourself or prove to to your community or friends or whatever, hey, look, I missed out on NVIDIA, but I got this other thing, that's maybe that might even do better. So I feel like then you'll set yourself up to kind of prove yourself, etc. I feel like that's just not a good strategy. And the other way to deal with FOMO, I feel like, is just to let it slide. Like that's really 100% from Stoicism, which is like a direct quote from Marcus Aurelius, to shrug things off, like they're nothing. So the worst thing that you can do as an investor is to beat yourself up for missing, or how, like I actually, like last week, I think I was either thinking or writing, or I was talking to someone, and I was like, how did I miss picking NVIDIA,
Yeah.
right? Like in my 10%. Like I was on top of this. I knew the whole AI stuff. And I remember looking at it thinking, oh, okay, this is awesome. They have this great position. But I also remember my kind of thinking was they'll probably do well, but I don't see them doubling.
Mhm.
That was my
When did you say? What year was that?
yes, last year.
Okay, yeah, I thought the same thing. Yeah.
Yeah. So I was like, yeah, within the next year, I feel like it's quite unlikely they'll double from this place.
Yeah.
And of course they did, right? Like from last year. So in my analysis it was unlikely. But when I look back, as soon as I start thinking that way, I'm like, I got to neutralize this. It's like, okay, this was my analysis at the time with the information that I was looking, or everybody, of course, says, but I just made a different decision. And that's okay because I still have exposure.
Mm. Yeah, true. Yeah.
Right.
Especially in the S&P. Yeah, exactly. Mm-hmm.
Yeah. So that way, I feel like even if you look at hedge funds and if you look at all of these investors, if you look at their quarterly reportings, most of them have SPY, right?
Yeah, they all own the same stocks. Yeah.
Yeah. So I feel like as an individual, you'll set yourself up for more success if you kind of have a good foundation.
Hmm. Any thoughts on what the next thing might be, or the next other thing, if not AI?
Yeah, I find it really difficult. I don't I don't have any thoughts on that. What the next thing might be. I do think that this AI thing is still riding well, but at the same time, I'm also aware of the fact that these things generally end abruptly as well.
Yeah. Yeah.
So other than that, I try to not, like we were saying, like I try not to pick the next thing. I feel like my 10% is more targeted towards like a Tesla or
Mm.
like an Adyen, where I feel like they've already had these massive runs and they're still solid company and they are still posting, well, in the case of Tesla, it's unclear in terms of their numbers and growth. But at least they've had these massive runs in the past.
Mm.
And they have great foundations and they are setting themselves up for more success in the future.
Mm-hmm.
So I feel more comfortable with those types of plays where I don't have to predict that much, right?
Yeah.
Because
Yeah.
I'm that's also one thing that I realized about myself. I'm not a great predictor of trends and where things are going on a macro level or on technology. While I am a user and on top of all of that stuff, I find that quite difficult to look at the new plays. So that's something that I try to,
Mm-hmm.
avoid spending too much time and energy on and focusing on things that I'm good at, which is to look at these companies that have performed well, that have been, in my opinion, punished by the investment community too harshly,
Mm-hmm.
and where I feel like I have the opportunity to be contrarian at that moment.
Nice. Very
Yeah.
good. That's a good place to close. Darius Foroux, thank you so much for coming on the Contrarian Investor podcast. Maybe in closing, you can tell our listeners how they can find out more about you, how they can find the book, and if you're on social media or anything else, and I'll put all those links in the show notes as well.
All right. Yeah. Thanks for having me. And the best way to learn more is go to my website, dariusforoux.com, or stoicpathtowealth.com to learn more about the book.
Cool. Are you on social media?
Yeah. Also on social media, not very active, but at Darius Foroux everywhere.
Okay.
Yeah.
Nice. I'll put that in the show notes as well. Awesome. Well, thank you so much for coming on, Darius. I really appreciate it. Thank you all for listening. We'll be back here again next time in a couple of weeks or so. Speak to you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.